Hey, good morning. Map here, Map Investments. Doing some catch-up videos. Haven't been doing many videos the last couple of days. I think I did the last videos on Wednesday. So I want to do a little recap on some of the things I did on Thursday and Friday in the market. Been busy with trading and also winding down the account for the holiday season and getting ready for a new trading year. And also, the market just keep continues to go up, and it's hard to find premium out there. So in the last couple of days, I've concentrated in a different strategy that I haven't done a video on, and that's the beauty of options, that there are many strategies for different environments. So I've been placing some calendar spreads in many underlyings that seem overextended, and there's research that shows that calendar spreads actually perform better than your regular debit spread and credit spreads, etc. When you're taking a bearish stance on stocks. I don't like to buy options, so when you buy like a bear debit spread, you have to pay for it, and you're fighting time, you're fighting theta. And call credit spreads, they do work, but they don't have the same outcome as debit spreads in research provided by Tasty Trade. And I'll find the video and I'll link it to this video on the ones on the calendar spreads that I've done, so you can see what I'm talking about. So for example, here's one stock that, if you look at this chart, it is just it's just parabolic. This is Redfin. They're a real estate technology company where people list homes and stuff. And this stock has basically gone from 42 and a half, if you look at the chart, basically from 42 and a half straight up to 76 and a half, basically. So there's ads here on this thing. Sorry about that. See if I can close it. So let me pull up the weekly so you could take a look at the weekly chart. Here's the weekly, right? So there's the weekly. Looks pretty good, but it's just, this stock in the pandemic, when it started, it hit like 10. We're at 76 and a half. There's a lot of euphoria going on, and I'm putting on these calendars because I expect some IV expansion and volatility to pick up, in my opinion. So I'm looking for underlyings with like parabolic moves. If you see this chart, it seems like, remember, these things always revert to the mean. The RSA is at 88. It has to give back some. The 50-day moving average is 49.96. You can see it right there, the 50-day moving average. And the 200-day is 37.93. Okay. So what I basically did was, let me go to my orders. Should be doing this on my desktop because I could show you on the Analyze tab a little bit better the how the trade breaks down. Okay, so filled. No, I had it pre-done here for the days that I did. Okay, so Redfin. Let's see the calendar spread I did in Redfin. See here. I did many calendar spreads on stuff that I thought were due for some pullbacks that seem overextended. Here's Redfin. So what does this trade consist of? So basically what you're doing, I only did two because they're debit, so I don't like to do a lot of them. I basically sold the January 50 put and I bought the February 50 put for a debit of 74 cents. That's what I basically did. Let me see if I go to the, maybe I'll be able to show you in the Tasty. I think I'll be able to show you in the Tasty platform how it looks. Redfin. Okay, so we're gonna buy, okay, so calendar, we're gonna buy a put. You see it right here on the bottom, under right here, go. All right, so what I did was, all right, let's see, does this one do February? So, and then strikes, let's see if it pays. Let's see. Actually, let me see. Pull up the Tasty Works. So it's the 50. The 50 strike down. Calendar. You see the IV rank is 14. That's very low. Very low IV rank. I wanted to do another thing, pull up, see if I could pull up the, I don't really trade a lot on this, so I'm trying to see if I could pull up the, so you get an idea how it looks on the, oh, here it is, on the table. Okay. So this one is, all right, so we need to bring it down. An expiration. Okay, so here's the trade. Perfect. You can see it here. Perfect. Here's pretty good, and I know how to switch back and forth. So you see, I sold the January 26 days to expiration, and I bought the 61-day put. So you sell the front and buy the back, and it's a slight debit. The debit was, on my case, 74 cents. That was the debit. So basically, there's a couple ways you can work this trade. You can manage it at the front month. At the 26 days, you can manage it. And basically, what you want to do is close out your long month and just keep the credit you collected on the front month. In this case, let's say the 75 cents for the two contracts, the $150 on that. You can do that. Or you could just wait for those to expire and you stay with your longs, which you lowered your cost basis. So this is the 50 in January, and I have it skewed back down to the moving average. This is this is just an engagement trade. It's a low probability trade, but if we get a sell-off, you know, I'm betting that it's going to revert to the mean and maybe go back to the moving average. So it's a bearish assumption at a low cost, and just an engagement tool if we get a pullback. So, and there's the one that I bought. So at the end, it's a net debit of 75 cents. So the expected move in January is $8, and in February is $15. Stock's at $75. So a $15 move, give or take, will put it at about 60 bucks. I'm at 50. So, but the idea is if the stock pulls back, you don't really have to be right and get to your strike. If the stock pulls back, what's going to happen is these options are going to expand. There's going to be demand for them. So this is more of a volatility expansion play. So that's why I skew them to the downside. If we get a sell-off and this stock, which is completely overextended, I'm assuming it'll get a pullback. as the IV expands, this shorter dated one is pretty far out of the money, but the one that's further out has more time, and the volatility should expand, and I should be able to make some money on this trade. That's my assumption, and my play is just an engagement, trade to stay involved in some of these stocks that are overextended, and this is called a calendar spread. I'm gonna tie in the link to a tasty work research that they did that talks about the performance of this trade versus just buying a put or call credit spread. You're selling in a low IV environment, or a debit spread, like buying an in the money put and selling one out of money. You're still fighting theta. This one helps you in the front month with theta, and then the back month has the one that you own, which you're looking for the IV expansion. So hopefully this illustration on this platform gives you a better idea of how the trade looks. This is the options table, and you can go over here to the curve, and this is the curve. This is how it looks on the curve. It doesn't show you much, but it's just front and then back. You see how the red one is, the front is 26 days and the back is the one that you own with 61 days. So it's a calendar spread. Hope you find this video educational. Please like, share, subscribe, comment below, and I'll show you some other calendar spreads that I've done, and I'll link the research as well from Tasty Works that they've done on calendar spreads. Thank you. Bye-bye.